Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 118, Top 5 Option Strategies for Monthly Income. So in this episode, I want to cover some of these monthly option strategies that you can use for monthly income. Some of the more common ones. There are many more option strategies than the ones that we will be covering here, but this will just give you a big picture overview if you're just getting started with option trading. It'll give you a big picture overview of how money is made from option strategies and just show you some of the common ones. We're not going to go in detail about managing or adjusting any of them. It's just a big picture view of some common strategies that you can use, that you can put on or play with or research a little more about prior to trading options. Before we get started, keep in mind all these are, again, for illustrative purposes. I think everybody should understand that by now, especially if you're watching stock market education videos or finance videos, because everybody's risk tolerance is different and you might be reading or watching a video at some time in the future. So, always contact your personal financial advisor before making any trades, because you could incur some significant losses if you don't know what you're doing. So put the time and effort to learn, but none of the things here are recommendations to buy or sell or trade any options or stocks. Now, before we get going, keep an eye out for some of the live classes that we're doing. And if you're on the newsletter member page, or if you're a newsletter member or subscriber, then you can get a free webinar every so often. So I just started doing these, and if you want a live session, then just go ahead and sign up to the newsletter, which is usually at the bottom of the page. You can just click here, button at the bottom of the page of the tradersfly.com button or tradersfly.com website. And when you're there, just sign up, and then you'll get access to when the webinars are for some of these things. And again, we do a few free webinars for the newsletter subscribers. So just go ahead and sign up if you're interested in those. And they are usually more interactive or specific to the stocks you want to cover or the lessons that you want to cover. So they can change depending on your needs. So without further ado, let's get into today's topic of the top 5 option strategies. So I'm going to use the Thinkorswim platform right here, which is by TD Ameritrade. And if we take a look at this platform, what you'll notice is, and we get into trading options, one of the first strategies that I want to share with you is going to be just a standard selling covered calls. So if we take a look at, let's just say, Amazon, and we go ahead and we buy Amazon, okay, you need 100 shares in order to do this strategy. You can do it on Amazon, you can do it on Netflix, any stock or ETF that you have that also trades options. So whatever one you want or that you're comfortable with, let's do Netflix since we're on here. First, you need 100 shares, because one option contract is 100 shares, or it controls 100 shares. So that's why we need at least 100 shares. So I'm going to go ahead and just buy this right now just to show you an example of how this really works. And you can see the cost here is right around $87,000 in margin. So I'm going to go ahead, send that in. And you can see right there, I got filled. It's a market order. I didn't use a limit order. So now if we go into Netflix now, you can see if it goes up 10 points, I make about $1,000 simply because it's right around the $130 price level. So this chart or this graph basically tells you here's your profit and loss, and here's the price of the stock. So as things continue to move up, you're more profitable, because here is our zero line. As things continue to move down, you lose money, okay, obviously beyond this line. So anyways, so as you look at this, and you can see as I move my mouse, I'm more profitable. As I continue to move it down, I'm losing money. So this all is based on, having stock, and you have stock. So the first option trade or strategy that you can use to making money, and it's one of the most common, is to sell upside calls. Okay, so this is called a covered call. So what you do here in this case is, let's just say you believe, and if we take a look at Netflix over here, we go to Netflix, so you can see right now we bought the stock around 130. So if I think it's going to, let's just say, sell off right here and just go lower, let's say this is resistance and there's some problem spots right here, I could sell a call contract at the 140, meaning it won't go as high as 140. So that's what it allows me to do. Normally, a call is for the upside. If you buy a call, you're looking for a stock to go up. However, when you sell the call, it's the opposite effect, right? You're taking the opposite side of the trade. So I could say, okay, 140 is right there. Okay, I'm getting about $4.05. I'm 36 days out. So what I do is I sell, and it's off the screen, a single, and I can analyze the trade. So now you can see how my graph changed. Looks a little funky right now, but basically the green line is the expiration line, the white line is the current line today. Normally we used to have a straight line to the upside. So with time, these contracts that we're selling expire, and that's what we're doing. We're selling insurance on the stock. So here, as I continue to move the date, you can see I'm making money through the theta right here. Okay, every day about $10, and that'll continue to increase. You can see as I'm moving the date, my profit and loss that's tied to this right here continues to rise and increase. So what you're basically doing is allowing these options to decay and expire through selling them. Now, the downside with this, of course, is if the stock continues to 160, you are forced to sell your shares at 140 because here's our initial position. And now if we put on this trade, one contract controls 100 shares, and we sell the 140, we're able to get the premium of 405. But if it goes beyond the 140, we lose out. So if it goes to 150, we are forced to sell it at 140, in which case we still make the profit from the stock from 130 to 140, but at 140, anything beyond that, you just don't get the additional profits. Okay, so basically, in simple terms, what happens is they take away your stock, you're going to make a profit from your stock, but you also get to collect the premium of that 140 call. Okay, and that's why you need to be able to own that stock. If you do it without owning the stock, the call is going to look like this, in which case you can see if it continues to head higher, you lose money. So what this can do is if the stock heads to, let's say, 250, you lose $10,000. That's why you need to own the stock to do this strategy. But you can see because this one on its own allows me for upside, selling the call is actually downside, but I'm at the 140. I'm further beyond what I'm buying it at. So putting these two together, the stock plus the call, allows me to still get some upside room. So if the stock stands still, I still at least collect some money. If it goes up a little, I make money. If it goes down some, I still at least make 405 on the call, which multiply times 100, you can see I'm making $405. Okay, so I'm still making some money even if it goes down rather than losing just on the stock value. But if it goes up past 140, I still get to keep my $405, but I sell the stock $10 away from where it is now, about $10 away. So that's the first strategy, and you can do this month after month. You know, some people, what they do is they have a couple thousand shares of stock, and then what they'll do is they may sell only 3 or 4 contracts, on those positions. That way they're always still having exposure, but they do it month after month, and continue to collect the premium. So this is one strategy that you can do on a consistent basis and make money every single month. Okay, so that's just selling a covered call strategy. The next strategy I want to share with you is a naked strategy, a little more dangerous, but you'll see the advantage to it here. So when you go into a naked strategy, and let's just say Amazon, for example, right here, let's say this stock got away from you a little bit, like it is right here. The stock broke out, you missed the move a bit right here. So what you can do in this strategy is it's a good strategy for if you want to buy the stock. This is if you want to own the stock and you have enough money to own the stock at a lower level. And again, I'm going to show you the stock is at 803 right now. Okay, but let's say you missed the move at 750 and you don't mind buying it at 740. So what you can do here in this scenario and situation is I can go to Amazon right here, okay, and I'm looking, again, this is 36 days out because right now we're in January 12th. So I could say, okay, I'm going to go into about the 740 right here or 735. What I'll do is I'll sell, and again, it's off the screen, a single, right-click Amazon or analyze the trade, and this is a put this time. Okay, so that means since I'm selling a put, normally if you buy a put, you want the stock to go down. But since we're selling a put, we actually want the stock in theory to go up. But this is also putting me in a position for unlimited losses until zero, which basically means people can put that stock to me at 735. So if the stock goes to 700, since I'm saying already I don't mind owning the stock at 735, this is what this is going to do, but it allows you to buy it at a lower level. So here's how this works. If the stock stands still, you again make money because you're selling the option. If the stock goes up, you make money. If it goes down, you start to lose money on this option premium and value, but in the end, you still get to capitalize and make this $780. Now, the big downside for this is if this gets to 720, you're going to be forced to own the stock at that 735 level, wherever the 735 level is, right around right there. So at 735, you're going to be forced to buy 100 shares because we have one contract of this stock. So basically, if the stock stands still, you make money. Stock goes up, you make money. Stock goes down a little bit, you can still keep the profits of $780 from this, so you still make money. The problem is at expiration, if this gets in the money, which is, let's make it orange here, anything below that $730 range right here, you will be put 100 shares of that stock at 735, even if that stock is at 600, even if that stock is at 200. Because what we're doing is we're saying, okay, I don't mind owning the stock at 735, 740. That's a good price level looking at this chart. And if you say that and you go ahead and sell a naked put on this, you're going to be forced to buy that if it goes below that strike price. But if it doesn't, you get to just keep the money. And you can do this month after month. And if the stock starts getting to 860, you can raise this to 750 and so on and so forth. Again, you can do this month after month until you get the stock. So it's another strategy that people do for nibbling on stocks or trying to bottom fish on stocks, because it allows you to capitalize at lower prices, but still you get to collect the premium if it goes against you. So that's another option strategy for monthly income. Strategy number 3 is just a vertical spread. So a vertical spread looks a little bit like, here, we'll do it also on Amazon. We're going to sell a vertical. And what a vertical is let's break it apart. First, I'm going to go ahead and sell a single. Okay, we'll start on the put side. Okay, so it's very similar to what we just had. And then what I'll do is I'll buy one for protection further out. In this strategy, you don't need to own the stock. You don't have to deal with anything with the stock. You will more than likely not get assigned the stock, because this is why you're buying a single one later down in the strike prices, because for this reason, it will offset. So what I'm doing here is, you can see, here's my selling one contract. And then if I buy a put, remember, it's for the upside. So I'm buying it, though, further out. Okay, that's what the difference in the strike price is. And this creates a picture profile like this. So now, the way this works is, okay, again, stock stands still, you make money. Okay, you make $13 per day roughly, plus whatever the time expiration value is. Stock goes up, you make money. Stock goes down, you make money, up until this little hashtag mark right there. Okay, so you'll make money all the way up to that point. Now, remember, all these things are taken into account, so the white line is the current line. You're not going to be making money right away. If this drops tomorrow within a few minutes, you're going to be down about $600, $700. But with time, that theta decay, you're going to get closer and closer to the green line at expiration. And that allows you to make, let's just say right here, looking at the difference, you make $630 so long as it's above that right around 740, 745 level, okay? So those are the strike prices we chose. If we decide to go further out, let's say 730 or 720, and I get protection at 700, I'm a little bit safer because I'm wider, but I make less money. So I would be making $205 in this case, but I'm much wider and further out than the 735, 740 level. So you can see how this really works. And by selling these verticals, it allows you to create money month after month, time and time again. Now, you can also do this by buying verticals, but then you need the stock to move in your favor. The next strategy would be to add on to this, and that is to create an iron condor. So if we look at this 720, 700 level, this right here is a vertical, and we could actually create this vertical by simply just selling, right-click sell a vertical, and it'll put it together for us. So again, I could do 720, let's just say 690, analyze the trade. I could even go, let's just say 725. So here's kind of my initial vertical right there. And then what I can do for our third variation or fourth variation is the iron condor. So now what I do is I do the same thing on the call side. And here what I'll do is I'll go to, let's just say 920. And here I'll sell, again, we'll do a vertical, analyze the trade. And now what I can do is go to something, play around with these strike prices. And you can see now I've created kind of a proportional trade where if the stock, as long as this stock stands somewhere or lands somewhere between these two price levels, between this about 900 level and 730 level, I make money. So it doesn't matter if it wiggles all the way in here up and down. I make money as this white line gets closer to the green line with time. As I move theoretical time forward, you can see how I make money. And my maximum that I would make from this is $578. How do they come up with that? Well, it's simple. You take this one, the put side that you're selling, that is $362. Okay, then you take this one, 216, you put it together and you get 578. If I start playing with the strike prices, and let's just say I get a little closer, 735, maybe 695, and get a little closer on this one, you can see that the profits will actually increase because I'm contracting my edges, getting closer. The chance of me succeeding is less, but I'm collecting more premium. So this is the next strategy that you can use in order to make money every single month. So far we covered selling the upside calls. We've covered the naked option. That's number 2. We've covered the vertical. That's number 3. The fourth is the iron condor. And the fifth one that I'm going to show you right here is going to be the calendar. Now, the calendar works a little bit differently. So if you know how options decay with time, and I'll just draw a quick little picture. Normally, they decay slowly here, and then they start accelerating. So as you start creating options and looking at options, this point initially might be at 60 days, and it decays slower. As you get into 40 days, it starts to pick up speed. As you get into 30 days, it picks up more speed. 15 days, it picks up more speed. Even at 100 days, they're still decaying. They're just decaying slower. So what we do in order to create a calendar, what you do is, let's just say you buy a single one first, and then you sell one. Okay, so the one that you want to sell is the closer out month. So when you start looking at your contracts and you start closing things up, the one you want to buy for protection is later out. Okay, so that would be the 64 days. So let's say if we're trading Amazon here, let's say at 800, and you can do this on the put side or the call side. So at 805, 810, let's do 810, we buy a single, okay? And you can see that with buying a single, you create this little graph that goes to the upside, again, just like a standard call. But now what you actually need to do is sell premium, because you're selling to be able to make money every month. A business makes money every month by selling products to you, just like they sell food, produce, electronics, they sell to you, they make money. And this is the way you do it as well in the option business. So here, again, I sell a single right there, analyze the trade, and now you can see what that does. And it calculates the differences between these prices and strike prices and the times and the dates to create a picture that looks something like this. Okay, so the way it works is really, remember, when you sell one, you're looking for downside. When you're buying one, you're looking for upside. So in theory, this could be a vertical, but since the time is offset, putting them together creates a picture like this. Okay, so what this now does is, with time, the one in March is going to decay slower than the one in February, since we have a March and February 810 calendar. The February one is going to decay much quicker than the one in March, simply because right now we're in January. So with time, the difference on that, you're making about $13. As I continue to move the date forward and the date up, you can see you'll be making about $205 within about a week or two. And that is if the strike prices, or the price of the stock, stays between about 760 and 870. Now, volatility plays a huge role within calendars, simply because you're a buyer of volatility, since you're buying time. But in general, you're looking for the stocks to stay around 760 to 870. Of course, you could start skewing these things, which is a little bit more of an advanced bonus. Let's say I can go to 800, and now you can start rotating it 790, and this will slowly start creating your diagonals. But if you keep the strike prices the same, that is your calendar, and you're making money through time expiration. You could also position them a little bit further out, such as 820 and 820, meaning if you're looking for more upside move and you want to still stay in that barrier, you could move them a little bit to the upside, even 835 and 835. That way, at least with time, as this stock continues moving higher, the white line will slowly get closer and closer to the green line, and you're going to be making a little more money. Now, keep in mind, your triangle of your calendar here is shifted a little bit to the right, to the upside, since it has an upside bias. But if you have a little bit of a negative bias, you could also do something like 785 and then switch this to the puts, okay? And now you can see you have a directional bias to the downside. So again, it really just comes down to your personal strategy, what strategy you like, and the way that you like to trade. But in this case, looking at price, the risk, the reward, this is another strategy that you could use to make money every single month. And you notice most all of these strategies that we've done, in fact all of them, you're really making money through this theta decay. That's how you make money time and time again, by using time in your favor. So that's how you really make money from trading options. And this is some of the very core and basic option money-making strategies for monthly income. So I hope you really found this video helpful. I know we didn't cover every single detail within the trade. There was no adjustments that we covered. This is just a starting point to get you to see the bigger picture of how money is made and what kind of trades you could do with options, and just get you started. And if you're a beginner, this is the starting point to do more research about these different strategies in order to continue to evolve your education. Thanks for joining me in this video. I hope you really found it helpful to opening up your mind about trading options and some of the common strategies. And if you want to sign up to some of the live classes that I have available, click the button over here on this side and register for my newsletter list, which is absolutely free. And then you'll be able to get notifications when those live classes are released and how you can schedule them for free. But if you want to continue just watching some more training videos, then just go ahead and click the button on this side. Thanks again for joining me. In the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.